Your investment advisor with you so that your investment advisor can take some good advice today and figure out how he or she will save your fortune. I want to just let you know that, as you may know, next week we're going to be looking at health, and we'll have a wonderful panel to join us for that. And then we'll be continuing on from there. How many of you have heard about what has happened in the election today? Some of you have not. You may have heard that in the latest ABC Washington Post poll, Obama has taken a 9-point lead by Obama-Biden over McCain-Palin. And that candidate McCain is asked to suspend his campaign because of the financial mess, and has also asked to cancel Friday night's debate. Obama has said, no, this is an important time for the next leader of the United States to be speaking to the American people. So this should be a very interesting 2 days ahead of us as all of this kind of maneuvering goes on. Any questions? Anybody want to make a comment before we start on all of this? As you can tell, the issues that we're talking about today, and I'm hoping Bob will kind of introduce this, have all of a sudden become the critical issues of the campaign. If you go back and you think about where this campaign began, it was really about Iran. It was about our defense policy and our foreign policy. You hardly hear a word about that today. It's all about the economy, and it goes back to a campaign that was really quite similar to 1992, when, of course, you had Bill Clinton and his people saying, it's the economy, stupid. We have seen, I think, Lynne Browne is going to tell us about fairly extraordinary events in financial markets, ones that even economists like myself have a bit of trouble understanding the depth of it. Perhaps even the people who are trying to solve the problem are having some problem understanding all of this. But it will give us a chance, I think, this evening more than ever to really kind of understand where we are and what's happening. So let's give us just another minute. Oh, question out here. Please, speak up.
It is a question. I noticed a survey in the Washington Post and whoever, ABC, and those, I think, are conducted on landlines.
Yes.
And I would imagine there are a lot of people in here who don't have one, only have a cell phone. Show of hands.
How many only have a cell phone?
So you're not getting surveyed? So you do have to vote?
Yes, indeed. Well, as most of my friends who are in the survey and polling business will tell you, and you know, the day after the election, the evening after the election, we have a class here, and we'll have Mike Dukakis, Professor Dukakis, and we'll have Rui Teixeira, who is a pollster from Washington, joining us, a friend of mine, to really figure out what went on. Were the polls right? Were they wrong? There are 1,000 reasons why nobody believes the polls this year. Part of it has to do with how do you deal with cell phones. Another has to do with the fact that we are out registering literally millions of new voters, almost none of whom are considered at this point to be quote-unquote likely voters. Whether they'll vote for McCain or Obama is hard to tell, but probably a very large proportion of them may vote for Obama. On the other hand, people worry about the so-called Bradley effect. The people who say they'll vote for Obama may not because of race. So what a year to be doing this. But Bob Culver, Professor Culver, is here. And so I want to turn the mic over to him, and we'll begin the evening's event. Welcome. You're on.
I was just going to use this for hands. Can you hear now with this? Let me just ask first, how many folks were not here last week? Wow, it's amazing how this works. So here's what happens. Before Lynn or Barry take over, we never imagined that as we put this class together, that the world would progress the way it has and with the speed it has. So what the duty that Barry has given to me is to introduce each of these classes, which I now do. And am I making this thing? No. To introduce each of these classes as if we are having a dialogue, if you will, with the new President of the United States, reporting what's going on. So this week it goes something like this, Mr. President, given that it will be Mr. Let me inform you, Mr. President, that during the time you will recall prior to your being elected, there was this class that occurred, and in the period of 3 weeks, we went from talking about the importance of the global economy and the growth rates, and then we'll be talking about this, Barry will be talking about the economic stuff. But we had touched on, by way of introduction, that we thought it was important that you understand what's going on globally, the growth rates of China, India, Russia, Brazil, the BRIC countries, and the impact that they would have on the United States economy, and it would probably be inflationary, and then really dealing with their growth rates versus ours was very important. We thought that maybe there would be some foreign currency issue if we found that the renminbi, the Chinese currency, devalued against the dollar, that maybe that would, the strengthening of the dollar would result, and maybe the reduction in energy resources the cost of energy would go down, and maybe that might have an effect on your environmental initiatives. We talked a bit about that last week. But, Mr. President, I'm here to tell you that we never envisioned that all of Wall Street would collapse. And here we are, Mr. President, to tell you that along with having to deal with the war and the debt associated with the war, that as of this moment, things are moving very rapidly on a $700 billion bailout, which I'm sure all of you have been hearing about. The implication for that is what is at question as we meet here tonight. And that is it net or gross, the $700 billion? That is, at the end of the day, if in fact Paulson and Bernanke got their way with their, was it a 6-page memo? Three-page memo? If Bernanke and Paulson got their way with their 3-page memo, and it was simply Wall Street, as Wall Street would like it, here, just give me the money and trust me. The question would be, what might we get in return? Because in fairness to all parties, what might be assumed, Mr. President, is that we are using this money to deleverage the economy, especially as it relates to the subprime mortgage environment, and that we would be selling or remortgaging or reinsuring some of these assets, and we, the taxpayers, would be getting back some part of this $700 million. We can't tell you, though, how much that is, and we can only tell you, or when that might occur, but that might occur. What we can tell you is that the impact that it will have on your planning for your Social Security reform, your health care reform, your educational reform, and your infrastructure activities with the United States will probably be substantially changed, and I would suggest curtailed. Also, Mr. President, it is clear that what you will probably have to focus on is not only the issues of terrorism and dealing with global issues, military and State Department issues, but in fact you are going to have to deal now with substantial issues of regulation, and will probably be forced to take on the SEC, Standard & Poor's, Moody's, Fitch, and trying to figure out how you're going to deal with AMBAC and MBIA. And oh, by the way, it's been announced that there's an FBI investigation going on of the 24 companies on Wall Street, and we don't know exactly where that's going. So that's where we're beginning this week. And Lynn, I don't know whether you're starting. Lynn is starting first, and then you know, has Lynn been introduced?
No.
Do you want to introduce Lynn?
I could, or you could.
Yeah, but Lynn is a great lady. Barry, you should be.
Okay.
Maybe I should introduce myself.
Introduce yourself.
No, you could. Lynne Browne is someone who's been active in this economy through the Federal Reserve Bank for years, and whose analysis has been relied upon as relates to jobs, employment, unemployment, and various policy decisions being made within the Fed for many years, and who has been a colleague of many businesses and many not-for-profit organizations in advising them and also participating with them over the years. She has also taken a lot of time to put this address together. So without further ado.
Well, actually, when Barry first asked me to speak at this forum, I thought I was going to talk about the New England economy and its growth over history for 200 years and its ability to reinvent
Lynne,
itself.
that microphone, excuse me, this microphone works and you don't need to hold it if you don't want to. This one right here.
That was fine.
Works fine.
And lessons that could be sort of taken from New England's experience and applied nationally with a new president. But then last week, Barry says, well, can you really tell us what's going on right now? And to be quite frank, I can't tell you, you won't find my explanation satisfying, but you may find it interesting. There is, obviously, the Federal Reserve System is in the thick of things. It is really a Washington, Chairman Bernanke, and Federal Reserve Bank of New York. They've been most active, but our own president, Eric Rosengren, as a member of the Federal Open Market Committee, part of their deliberations, and as a specialist in the effect of financial markets on the real economy, has been actively involved. So in any event, I'm going to try and sort of lay out for you sort of what has gone wrong. I mean, because not so long ago, in fact, even a couple of years ago, it seemed that U.S. financial markets seemed vibrant. They were drawing capital from all around the world, generating huge profits for the Wall Street firms, huge bonuses for their employees. Now, many of the leading companies are bankrupt or have been acquired near bankruptcy. We see sort of credit has become much more difficult to get. So what has happened? I mean, the bottom line, sort of the ultimate message is that financial markets are based on leverage. They're based on borrowed money, and they're based on trust. And if there's no trust, the dependent on leverage is devastating. I mean, you've always heard the sort of expression, or many of you have heard the expression, sort of, when you really need money, nobody gives it to you, and when you don't need the money, everybody wants to lend to you. Well, that really is quite true. The immediate cause is the subprime mortgage debacle in the United States. Underlying and contributing factors are actually a global savings glut that channels funds into the United States and the rapid expansion of highly leveraged financial institutions outside the traditional regulatory purview. Financial innovations and accounting and regulatory changes have had strange and perverse effect. Basically, I mean, a number of you may have heard talk of a global savings glut. Basically, the emergence of China on the world stage as a huge economic player, and it has an extraordinarily high savings rate, high investment rate, but savings rate exceeds investment. Funds from China came to us, funds from Japan and Western Europe, which have declining populations or the prospect of declining populations, and therefore their investment opportunities are quite limited compared to their savings rate. Even the oil surplus, the oil producing countries had large surpluses because of the high price of oil. So there was a lot of sort of excess money outside of the United States, and they look to the United States, the world's largest country with the most sophisticated financial markets, as a place to put that money. But this inflow of funds from all around the world encouraged risk-taking. It fueled the growth of financial services companies, but it also encouraged risk-taking, because when you have a lot of money going after limited investment opportunities, how do you generate high returns? How do you generate how does everybody get to have better than average returns? Not possible. The way to generate high returns, although it wasn't really acknowledged or recognized, is by taking risk. Meanwhile, the financial services industry has changed in important ways that are not always sort of fully recognized. The old days of small and medium-sized banks taking deposits from local customers to lend to local customers, they still exist, but they're not historic. They're not that important. Increasingly, the banking industry is dominated by very large institutions that operate nationally and even globally. These large institutions have in many cases moved into activities that were traditionally associated with investment banks. These were often more lucrative opportunities, but riskier opportunities. Until the early 90s, they couldn't do this because of restrictions on their activities that were imposed because of problems that arose in the Great Depression. But in the early 90s, the division between investment and commercial banking were removed, and the commercial banks, the large commercial banks, moved into the investment banking arena. And some have argued that forced this increased competition forced the investment banks to engage in more aggressive and riskier strategies. Although at the time, of course, this was characterized as innovative and being more innovative. Other financial services institutions also grew in importance, and what particular relevance to the subprime story is the growth of mortgage banks. Mortgage banks basically make their money on fees for originating mortgage. They evaluate the creditworthiness of the customer, they value the quality of the underlying collateral, and they make the yes-no decision. But then, once they've approved the mortgage, they sell it off, typically as a part of a large package that form a residential mortgage-backed security. Now, banks do this too. Thrift institutions do this too. They often sell off in packages the mortgages that they make, but they also can make money the old-fashioned way by lending the money, keeping the mortgage in their own portfolio, and earning the interest on it. The key thing about mortgage banks is they make their money on volume, on the fees generated by making more loans. Another set of financial institutions that has grown in importance, but nobody really has a good sense of how important it is, but it sort of is a shadowy figure, or shadowy set of figures sort of behind the current problem, are the hedge funds. Hedge funds cater to wealthy investors, including universities actually, seeking high returns and oftentimes diversification into non-traditional assets. They employ a variety of strategy. Hedge might suggest that they employ conservative strategies, but some of them, in fact, can be engaged in activities that you might view as highly speculative and risky. They're lightly regulated, and in fact, most of the regulations associated with hedge funds limit who can actually invest in them. So they're basically, the regulations are designed to keep smaller, presumably less sophisticated people from investing in hedge funds. There isn't really a comprehensive or reliable source of information about hedge funds and their activities, but when you see sort of the lists of the U.S.'s wealthiest people, they often involve a lot of people from hedge funds. There has also been a proliferation of investment vehicles of increasing sophistication and complexity. I'm going to talk at some length about residential mortgages in a moment, but mortgages are not the only asset that can be securitized. All sorts of things are securitized: commercial real estate loans, loans on hotels, loans on sort of office buildings, credit card loans, motor vehicle loans, trade credit. But the whole idea behind securitization is that you put this package of assets together and it yields a cash flow. And securities are issued based on the cash flow that this pool of underlying assets generates. This is attractive because it can allow you to diversify. For example, in the case of, say, I want to invest in commercial office buildings, rather than investing just in Boston downtown office building, I might be able to sort of, if I was an investor wanting to do that, buy a security that was underpinned by the cash flow from commercial real estate mortgages all across the country. So I don't really need to worry that, say, Boston, the city of Boston might have a real estate glut. I could pool across all of the country. It also allows you to diversify across asset classes, and you can tailor sort of that cash flow to meet the needs of different investors who have, say, different risk preferences, different timing preferences. Another instrument that has grown in importance and that plays a role in our current financial problems is the credit default swap. In simple terms, a credit default swap is a contract between two parties. Say Barry and I decide that we're going to engage in a credit default swap, and one of us agrees to pay the other one if some event constituting a default occurs. Credit default swaps allow someone who, say, holds a corporate bond. Say I have a General Motors bond, and we're sort of worried about General Motors. I mean, we know sort of it's had some problems. I could buy a credit default swap that would provide some insurance in the event that General Motors did go bankrupt, and I would get I could get money back. I would have to pay a fee for that, but I would get a payoff in the event that the bad thing happened and my bond wasn't worth anything. So they are sort of seen as a very attractive hedging opportunity, except I don't actually have to have a General Motors bond to actually engage in credit default swap. I could just think, I think General Motors going down the tubes. I want to take a bet on that, and so I could actually just buy protection. I could buy insurance against the event that General Motors does default, even though in fact I don't have anything to hedge, and if it did default at some point, I would get a payoff. Of course, I do have to be sure that whoever I engage, I mean, if I engage with Barry, would Barry actually have the money to pay me off if that actually happened? So it's it can be very useful as a hedge. When you often hear them described, they are described in hedging terms, but they can also be sort of a way of making a bet. Well, let me turn now to the mortgage market, and specifically the subprime mortgage market. The reduction in interest rates in response to the stock market crash of 2001 and the terrorist attack of September 11th, Federal Reserve, in response to those events, dropped the federal funds rate very substantially. And in response, pretty much all interest rates came down. Low mortgage rates encouraged a wave of mortgage refinancing. It also encouraged a lot of purchases of existing homes, and it also encouraged a lot of new construction. At the time, there was a lot of commentary that actually investing in housing was a really good deal. Here, the stock market had just crashed. People had money, decided, well, I don't want to put it into the stock market. Who knows what's going to happen? I'll put it into second home, or I'll buy a bigger home. And many of you may be able to remember that. And housing seemed really attractive because at the time, housing prices nationally were rising about 6-7% a year. In addition, at the national level, nominal housing prices had never declined in 40 years, basically since the Great Depression. There were declines in region. Prices fell in Texas in the 80s. They fell in New England in the early 90s. But nationally, housing prices had not declined in nominal terms. Subprime lending had grown rapidly in the mid-1990s, but it sort of had a hiccup after the crisis of '98, picked up in the early, after 2000, but nobody noticed for a while because there was so much regular refinancing going on. But by 2006, 20% of the value of mortgages that were being originated was subprime. This was up from 7%. Actually, here's my chart. I think the chart shows that. If you look at the bottom two lines, this is U.S. and Massachusetts. This shows sort of what's going on with the subprime. The pale yellow line at the bottom is fixed rate subprime mortgages, and the pale or the red line is subprime, and that just shows their market share. You can see them growing very rapidly in that 2000 to 2006 period. All of a sudden, their market share is quite significant. Another, so they were basically 20% of the value of mortgages originated in 2006. We combined that to basically the fixed and the variable rate. In addition, you have another 13% of mortgages originating, which are what are called Alt-A mortgages, which are up from 2% in 2001. They don't show up here. They're considered a prime mortgage. Subprime loans have traditionally been made to borrowers who have flawed credit, and higher interest rates are charged in order to compensate for the higher likelihood of delinquency. Alt-A loans, which are also significant, are traditionally loans to borrowers with pretty good credit scores, but there are certain characteristics of an Alt-A loan that make it somewhat risky. In particular, Alt-A loans are often stated income loans, where someone basically just says my income is X, and it's not verified. A number of factors spurred the growth of subprime lending. You had the emergence of a number of sort of mortgage banks that specialized in the subprime market. A number of them specialized particularly in going after sort of minority community markets. But the real impetus came from rising housing prices. The country was entering a housing boom. The rate of appreciation was picking up. More people wanted to enter the ownership society. But what the rising housing prices meant was you could lend to borrowers with weaker credit scores and with other attributes, borrowers with higher loan-to-value ratios, because if those borrowers ran into difficulty, they could refinance because the housing prices are rising. They could refinance. Maybe they could even extract some cash. In fact, they probably would refinance. And if they couldn't refinance it for some reason, they just really could not support the house, with the market being strong, you could resell. So there was a big sort of, the rising housing prices made people more willing to take out these loans. Everybody was assuming that they would sort of see housing prices continue to rise. And at the same time, Wall Street was really, really interested in securities based on subprime loans. They charge pretty high interest rates. Your typical subprime loan it's called 228. It has a fixed interest rate for 2 years of about 7 to 8%, which then after 2 years resets to a variable rate, which is tied to basically LIBOR. But it's generally a higher rate. In fact, very few people wait for the reset. They usually try and get it refinanced in advance. So they refinance, which generates more fees for the brokers and the mortgage banks. But it also means, too, you get sort of the investor gets cash back, gets paid off pretty fast. But meanwhile, you're getting the 7-8% interest rate, which is pretty attractive in this environment. So Wall Street was very, very interested in this, and it's as long as housing prices kept rising, and they've always been rising. It looked like these things were pretty safe. All the major Wall Street investment houses became underwriters of subprime mortgages, securitizations. The top underwriters of subprime mortgage-backed securities in 2006 were Lehman Brothers, RBS Greenwich Capital, Morgan Stanley, Merrill Lynch, Countrywide Securities. It was the biggest one that wasn't Wall Street. Goldman Sachs and Bear Stearns were in the top 10. Investor appetite for these securities was very strong. The foreign investors' holdings of foreign investors just lapped these things up between 2003 and 2006. Everybody wanted it. And it seemed like, I mean, this was great because you could create, out of this package of mortgages, you could create securities where the claims on the cash flow from the securities would be different. So you could appeal to people who wanted what they thought was a really safe security, and you could also offer people who were willing to sort of take some risk, you could offer them a pretty high return. Basically what they would do is they'd have this package of securities, or package of mortgages, and a special purpose entity, a trust, would hold the underlying mortgages, and it would issue the securities. And it would issue them, it would create a tiering. They're called tranches, from sort of least risky to most risky. And it would set up rules that directed that the flow of principal repayments really went to the least risky first, so that they could be sort of guaranteed that they would be paid off first, and that the lowest rating ones, they would basically be paid off last. And based on the history of default rates with subprime mortgages and estimated default rates, it seemed that you could basically have some 70 to 80% of mortgages could be actually classified in